There is a crisis hiding inside the American banking system right now that is bigger than most people realize, moving slower than most crises do, and threatening to hit ordinary Americans in ways that will feel very personal when it finally arrives. $930 billion in commercial real estate debt matures in 2026, a sharp jump driven by years of loan extensions during the low-rate era. CNBC. The office buildings that anchor downtown skylines in every major American city are defaulting at rates that have now surpassed the worst levels recorded during the 2008 financial crisis. In January 2026, the delinquency rate for office mortgages securitized into commercial mortgage-backed securities hit 12.34%. A new all-time high, and a staggering 1.6 percentage points above the worst moments of the financial crisis. BEA and the banks holding the loans on those empty buildings, the regional and community banks that provide most of the small business lending, most of the agricultural credit, and most of the local mortgage financing in cities and towns across America are sitting on exposures that regulators and independent researchers are now describing with the kind of language that should command your full attention. According to Florida Atlantic University's analysis, 1,688 banks have total commercial real estate exposures greater than 300% of their total equity capital, the threshold at which the FDIC defines a bank as carrying excessive exposure that puts it at greater risk of failure. NPR 1,788 banks. In a country with approximately 5,000 banks total, that means more than one-third of all American banks are carrying commercial real estate exposure that regulators themselves define as dangerous. This is the story behind the story of the empty office buildings, and it is time to understand exactly what it means for your deposits, your loans, and your financial security. Before we break down every dimension of this crisis, please take 5 seconds right now and hit the like button. This is financial reporting that most mainstream outlets are not covering with the honesty and depth that it deserves, and getting it in front of the people who need it depends entirely on your engagement. Share this video with anyone who banks at a regional or community bank, owns commercial property, works in an office building, or simply wants to understand the risks that are building quietly inside the American financial system right now. Subscribe to this channel and press the bell notification so you receive our updates the moment we publish them. We are here every week connecting the dots that matter most for your financial life. Now let us get into the complete picture. Start with the foundational question that frames everything else. How did $930 billion in commercial real estate debt end up maturing in a single year? The answer is a story of extend and pretend, the practice by which banks, rather than forcing defaults and taking losses, repeatedly extended loan terms to buy time in the hope that interest rates would fall and property values would recover before the reckoning arrived. During the low interest rate era of 2020 through 2022, commercial real estate values were inflated by cheap debt. A building that generated $5 million per year in net operating income could support a $100 million loan at 3% interest because the annual debt service was manageable at those rates. When rates rose rapidly from near zero to above 5% between 2022 and 2023, the math inverted. That same $100 million loan at 5.5% required annual debt service that the building's income could no longer cover, particularly in an office market where vacancy rates were rising simultaneously as companies embraced hybrid work and reduced their physical footprint. Rather than force defaults and recognize losses that would have required them to raise capital, banks chose to extend loan terms, often by 12 to 24 months, betting that the Federal Reserve would cut rates quickly enough to allow refinancing at affordable levels before the extension expired. The tactic of extend and pretend, where banks extend the maturity of loans to weak borrowers and pretend they will eventually be able to repay, remains widely used, buying time but also potentially postponing a reckoning. Yahoo Finance. The problem is that those extensions have now expired or are expiring, and the Federal Reserve has not cut rates nearly as much or as quickly as the extend and pretend strategy required to work. The result is the $930 billion maturity wall of 2026, a concentrated pile of debt coming due simultaneously in an environment where refinancing remains expensive, property values have fallen, and the extend and pretend strategy is running out of road. The office sector is the epicenter of this crisis, and the data that describes its condition is extraordinary in its severity. National office vacancy rates remain near record highs, with many major markets seeing vacancy rates above 20%. 4 straight years of cumulative occupancy losses have eroded cash flows to the point where many buildings simply cannot service their debt. The motley fool. In specific cities, the numbers are even more extreme. Portland leads with a 38.4% office vacancy rate. Atlanta, Chicago, and Philadelphia sit above 28%. Baltimore is at 26.6%. Denver's downtown vacancy has hit 38.2% in Q4 2025. Connect Money San Francisco, once the most expensive office market in the United States, has seen vacancy rates approach 35% as the technology companies that drove its office boom shifted to remote and hybrid work arrangements and reduced their physical footprints dramatically. According to Capital Economics' latest outlook, office values in major U.S. cities are projected to fall by 35 to 50% from their 2020 peaks before finding a floor. This is not a cyclical dip. It is a structural reset. Charles Schwab. The word structural is critical here. A cyclical decline in office values implies that demand will eventually recover as economic conditions improve. A structural decline implies that the underlying demand for office space has permanently diminished due to changes in how and where people work, meaning that even in a strong economy with low unemployment, office buildings will not fill back up to their pre-pandemic occupancy levels. A 2026 report by McKinsey Global Institute warns that up to 30% of global office inventory may be functionally obsolete by 2030, meaning it will never again generate sufficient revenue to justify its operating costs. Charles Schwab. 30% of global office inventory permanently obsolete. That is not a temporary headache for property owners. That is a permanent impairment of the asset class that underpins hundreds of billions of dollars of loans held by American banks. The specific loan dynamics that make the 2026 maturity wall so dangerous deserve careful explanation because they illustrate precisely how a decline in commercial property values translates into a banking crisis. The borrower is underwater. No bank will refinance the full amount. They will demand a massive equity injection to right-size the loan-to-value ratio. Most owners will not or cannot write that check. Charles Schwab. A concrete example clarifies the mechanism. A building purchased in 2019 for $100 million with a $65 million loan at 3.5% interest is now worth $60 million following the 35 to 40% decline in office values that Capital Economics documents. The original loan, which was made at 65% of a $100 million value, now exceeds the current value of the building. No rational lender will refinance $65 million against an asset worth $60 million. The owner's options are to inject fresh equity to bring the loan balance below current value, to sell the property at the depressed price and absorb the loss, or to hand the keys back to the lender and walk away from the investment. For many owners, particularly those who have seen similar losses across multiple properties simultaneously, the third option is the rational financial choice. 2 Manhattan towers triggered the January 2026 spike in office CMBS delinquencies. One worldwide plaza with $1.2 billion in debt failed to cover its tax bill and debt service. Vacancy rose from 10% in 2024 to 37% in 2025 as major tenants downsized or left. CNBC One New York Plaza, a 50-story financial district tower, went into maturity default in January 2026, when its balloon payment was not made. These are not obscure suburban office parks. These are landmark Manhattan towers whose defaults are being reported in the Wall Street Journal and Bloomberg because they signal to the market that not even the most prestigious addresses in the most important office market in the world are immune from the structural shift in demand that is driving this crisis. More than 50% of the $100 billion in commercial mortgage-backed securities office loans coming due this year are projected to miss maturity payments, according to Morningstar DBRS. In previous years, over 75% of such loans were paid off at maturity. 24/7 Wall St. When more than half of all maturing office loans cannot be paid off at maturity, you are not looking at a stress event affecting weak borrowers at the margin. You are looking at a sector-wide repricing that is forcing write-downs across the entire asset class. The delinquent balance for office CMBS alone has ballooned to over $74 billion, representing a massive concentration of risk. This figure is part of a total outstanding CMBS balance that now exceeds $600 billion. BA. Now here's the question that connects the commercial real estate crisis to the personal financial security of every American who uses a bank. Who is holding the loans on these defaulting buildings? The answer is both reassuring and alarming depending on which part of the banking system you are examining. The key structural difference from the 2008 meltdown is where the risk sits. In this cycle, the banks that originated the loans are typically off the hook. The risk was transferred to global institutional investors through securitization. This means the financial pain is being absorbed by a wide array of pension funds, bond funds, and insurers, not by the commercial banking system. BEA. For the large Wall Street banks, JP Morgan, Bank of America, Wells Fargo, and Goldman Sachs, commercial real estate is a relatively small percentage of their enormous and diversified balance sheets. They can absorb the losses. But the story is entirely different for regional and community banks, and this is where the crisis becomes personally relevant to tens of millions of ordinary Americans. Community and regional banks are almost 5 times more exposed to the commercial real estate sector than big banks, with CRE holdings comprising 13% of large U.S. banks' balance sheets and 44% of regional ones. Yahoo Finance. When 44% of a bank's loan portfolio is exposed to an asset class experiencing a structural 35 to 50% decline in values and record-high delinquency rates, the potential for meaningful losses that impair the bank's capital position is not theoretical, it is mathematical. According to an independent academic paper from USC, Columbia, Stanford, and Northwestern, 14% of all commercial real estate loans and 44% of office-related loans appear to be in negative equity, meaning the current value of the property serving as collateral is less than the outstanding loan balances. Furthermore, the paper estimates that around 1/3 of all CRE loans and the majority of office-related loans may face significant cash flow problems and refinancing challenges. Charles Schwab. The banking system has already seen its first commercial real estate-linked failure of 2026. Illinois regulators seized Metropolitan Capital Bank and Trust, which had $261 million in assets, and appointed the Federal Deposit Insurance Corporation as receiver. A review of court records and enforcement filings shows the Chicago bank had long-standing exposure to a real estate loan tied to the largest default in the federal government's skilled nursing facility lending program. Regulators had imposed a consent order in 2019 requiring management changes, higher capital levels, and restrictions on substandard lending, citing unsafe and unsound conditions and an impaired capital position. Bloomberg Metropolitan Capital Bank and Trust is the first FDIC-insured bank failure of 2026. It will almost certainly not be the last. Roughly 31% of all banks, which represents 1,374 banks, were classified as commercial real estate concentrated at year-end 2024, according to FDIC data, and the number has been rising. CNBC. The extend and pretend strategy that has delayed this reckoning is now, by most measures, reaching its operational limits. Private capital, especially mezzanine debt, has helped delay defaults, but cracks are showing as capital values fall. Foreclosure activity is rising, and MSCI expects a surge in apartment foreclosures as 60% of 2021 to 2022 loans mature this year. Even with recent interest rate cuts, refinancing remains expensive. Loan terms are tighter and market confidence is shaky. CNBC. The mezzanine debt market, which is the layer of higher risk, higher yield financing that sits between senior debt and equity in commercial real estate capital structures, has been the critical shock absorber that has prevented the office crisis from becoming an immediate banking crisis. But as MSCI's own analysts noted in their most recent outlook, that mezz stuff is where there is pain in the cycle, and the pain is now arriving. The regional bank exposure to this crisis is not uniform, and it is not necessarily catastrophic for the entire sector. There is an important distinction between banks that hold diversified commercial real estate portfolios across multiple property types and geographies versus those that are concentrated in office lending in high vacancy markets. Industrial properties maintain a 96.8% occupancy rate with low distress levels. Data centers are at 99% occupancy. Grocery-anchored retail continues posting steady numbers. The multifamily sector shows resilience with a 0.5% delinquency rate for commercial mortgage-backed securities loans due in 2026. The Motley Fool, a regional bank whose commercial real estate portfolio is weighted toward industrial, data center, and grocery-anchored retail, is in a fundamentally different position from one that is heavily concentrated in suburban office buildings in markets where vacancy rates have exceeded 25%. The crisis is highly concentrated by property type and geography, and the banks that survive and thrive through it will be those that made smarter choices about which segments of commercial real estate to lend against. The broader economic consequences of a sustained regional banking stress event deserve careful attention because they extend well beyond the banking sector itself. Regional and community banks are the primary source of small business lending in most parts of the United States. They provide the capital that allows local restaurants to expand, local manufacturers to buy equipment, local retailers to manage inventory, and local real estate developers to build the housing that the country desperately needs. When regional banks face capital pressure from commercial real estate losses, they reduce lending, they tighten standards, they say no to loans they would have approved a year earlier. That credit contraction spreads through local economies in ways that do not show up dramatically in any single national data point, but that collectively amount to a meaningful drag on small business activity, local employment, and community economic vitality. For anyone trying to understand what this means practically for their own financial position, 3 specific and actionable points deserve emphasis. The first is that the safety of your bank deposits depends on the financial health of your specific bank, not on the health of the banking system in the abstract. The FDIC insures deposits up to $250,000 per depositor per institution, which means that any deposits above that threshold at a single institution carry some level of risk in the event of a bank failure. In a normal year, this is a theoretical concern. In a year when the first FDIC-insured bank of 2026 has already failed in February, and when 1,788 banks are carrying commercial real estate exposure above the regulatory danger threshold of 300% of equity, it is worth knowing your bank's specific commercial real estate exposure and ensuring your deposits are within FDIC-insured limits. Publicly available data from the FDIC and from independent research services allows any depositor to look up their bank's commercial real estate concentration ratio and assess their exposure relative to the regulatory thresholds that define excessive risk. The second point is that the commercial real estate crisis is creating genuine investment opportunity alongside genuine investment risk. Periods of dislocation bring opportunity. For investors with dry powder, 2026 could unlock a wave of discounted acquisitions. Properties unable to refinance will come to market, often with motivated sellers. For savvy owner-operators, it is a chance to upgrade portfolios by acquiring distressed assets, recapitalizing at favorable terms, or converting outdated properties into higher-performing uses. Supreme Court of the United States. The K-shaped divergence within commercial real estate between trophy office assets in prime locations and zombie buildings in secondary markets is creating a buying opportunity in the former that experienced commercial real estate investors with adequate capital and patience are beginning to exploit. For individual investors without the capital to acquire commercial properties directly, publicly traded real estate investment trusts focused on industrial, data center, and healthcare properties represent a way to access the strongest performing segments of commercial real estate while avoiding the distressed office exposure that is generating the crisis headlines. The third point is the most important one for anyone trying to maintain perspective in a situation where the data is alarming but the outcome is not yet determined. The crisis is severe but not yet systemic, as the distress is concentrated in one property type. The key structural difference from the 2008 meltdown is where the risk sits. In 2008, the financial system was deeply entangled in toxic mortgage assets, with banks holding the bulk of the risk. Today, the banks that originated the office commercial mortgage-backed securities loans are typically off the hook. BEA. The risk has been distributed across pension funds, bond funds, and international institutional investors in ways that reduce the probability of the kind of bank-run contagion that turned the subprime mortgage crisis into a global financial catastrophe in 2008. The pain is real, and it will be felt. But the probability that it triggers a systemic collapse of the kind seen in 2008 is meaningfully lower than the headline delinquency numbers might initially suggest. What is more likely is a slow, grinding correction that plays out over several years, with regional banks in the most exposed markets facing merger pressure, capital raises, and in some cases regulatory intervention, while the broader banking system absorbs losses that are significant but not existential. The investors and depositors who navigate this successfully will be those who understood the terrain early, checked their bank's commercial real estate exposure before any crisis became acute, stayed within FDIC insurance limits, and recognized that within the distress, there are investment opportunities in the strongest segments of a sector that is repricing to reflect a fundamentally new reality about how and where people work in the post-pandemic economy. This has been your complete financial briefing on the commercial real estate crisis and its implications for the American banking system for the week of March 9th, 2026. If this video gave you information you needed and clarity you could not find anywhere else, please like it right now, share it with anyone who banks locally or has exposure to real estate, and subscribe with the bell notification so you never miss our next update. We will be here every week with the analysis that connects the dots that matter most for your money. See you in the next one.